Start. Let's start. Last class we were at we have done, I think, question number. I showed you one question which was basically the interest rate swaps, na? Yes. Let's do a small warm-up exercise first before we move. It's okay. Let's do a small warm-up exercise before we do. Let's look at question number 11. Read question number 11 once quickly, please. It's a swap of a fixed versus floating, I think, and look at the numbers carefully. It says a dealer quotes all-in cost a generic swap at 6%, against 6 months LIBOR flat. Generic swap, generally we can call it as a plain vanilla swap. He can ask you this name in the MCQ. What is a generic plain vanilla swap? That means no complications at all. Against a 6 months LIBOR, if the notional principal amount of rupee swap is 8 lakh, calculate the semi-annual fixed. Basically, one would pay fixed and second would pay what? Floating. So if let's suppose there are A and B, the answer has been given. If let's suppose there are A and B, so one party will give to the other fixed and second will give the floating, and he says semi-annual fixed payment. What is the fixed payment rate? He is saying 6%. Now the problem of the question was, let me read it completely and then we'll come back. Find the first floating rate payment for one above if the 6 month period from the effective date of swap to settlement date comprises of 181 days, and that corresponding LIBOR was 5. This is for floating on the effective date of swap. In 2 above, calculate, that means in 2 above, if the settlement is on net basis pages, how much fixed rate payer would pay to the floating rate payer. Generic swap is based on 30 by 360. The problem of this question was basically one side it is used 181 days, second side it is used 180 days. It's not that you would have wanted, but he has given, look at this, generic swap is based on 30 by 360 days. That means LIBOR, leave it, generic swap is 6%. So semi-annual payment would be its a notional amount into 6% into 180 by 360. So one party will give to the other what? 24,000. So that means you can assume one is giving to the second 24,000 as fixed. Now second is giving what? Floating. So if second is giving floating, for that LIBOR is what? 5. But make sure you are using how many days? 181 days. So when you use 181 days, 2 ways of answers he has given. Actually, if you look at, he has given 8 lakh into 5 into this. This is the only problem. Otherwise, this question was straightforward. I might not have discussed with you. Generic swap, he is mentioning clearly. It's used 180 days, and for the floating, you have 181 days. So why 2 answers are given? They have a tendency of calculating. Sometimes they do is this can be written as either this way you calculate directly on the calculator, or you calculate, I think, 8 lakh into 0.05. Tell me 181 divided by 360, how much does it come? 180 by 0.503. So if you calculate this way, one of the answers would come. If you calculate this way, one of the answers would come. Which one is coming? 120. So if you multiply this, I think first answer would be coming. So examiner has given both of them. Sometime I was talking to you that if you put in the points or not. Now how do you know should I put in the points or not? So these problems would come, but how extent they'll give it, I don't know. In this particular question they gave it. So this is 8 lakh into 0.05 into 0.503, which comes out. And then say how the net settlement will take place. That means one person is giving to the second is 24 and second is giving what? Any of the amounts you can choose. Answer can come. So be very careful please. Generic swap was based on 30 by 360 very simple. This was one part here. This was a general question. Now coming back to one of the question which has not repeated itself for a long time is sixth question. Prima facie this question would appear very straightforward and very simple, but it's if you do not understand the feel of the question, it's next to impossible to solve it. So I am expecting yes. So this question is something which I think would repeat sooner or later. Read this question once, then I'll tell you. And everything would be in the first line itself. Everything would be there in the first line itself. It says ABC Bank is seeking fixed rate funding. Is seeking a fixed rate funding. Now understand the feeling of the first line itself. ABC is a bank, they want to raise a fund and they are looking for fixed rate funding. It is able to, full stop. It should have given correct wording, should have, but it is able to. So instead of that, he's saying it is able to finance at a cost of 6 months LIBOR plus 1/4. Let's suppose I am a ABC bank, I wanted to the market, I went to the market, I wanted a fixed rate, no matter what the rate would have been. It's not argued. It's a 8%, 7, but he wanted fixed. But when he went to the market, he was able to achieve what? A floating rate funding. And floating rate was given to him as what? 6 months LIBOR plus 1/4%. That means 0.25 for 200 million for 5 years. The bank is able to swap into fixed rate at what? 7.5. Fixed rate at 7.5 versus 6 months LIBOR. Now treating 6 months exactly half a year, what will be the all-in cost funds to ABC? It means what he would have done was, if it's a ABC bank, actual loan which he took came at what rate? Actual L plus 0.25. And then he was able to create a swap. He is not mentioning who is giving fixed to whom, but he wants in hand what? Fixed. And as of now, actual is going what? Floating. He want to reduce this floating. It means he will do what kind of agreement? Receive fixed and pay floating. So receive floating and pay fixed, because if he receives floating will come and floating will go. Sir, would he go for L plus 0.25, L, whatever he mentions will go? He mentioned he'll do swap. There are two types of agreement. One is when he went to the bank, actual loan was taken at L plus 0.25. That's one part of the question. Second is he want to remove that floating. He is concerned about that L. Now to remove that floating, if my floating is already in outflow and if I am doing a swap with you, in that swap I cannot have L as outflow. L should be what? Inflow. So if one is inflow and one is outflow, automatically that gets cancelled, and then I know I am paying 7.5 and maybe this 0.25. Sir, would he do a swap of L plus 0.25 or he will do swap of only L? Since he is mentioning he will do only of L. It's not L plus 0.25. Objective is not his cost will increase or not, because we do not know L. He wants to remove that L. If you look at this diagrammatical presentation, if you look at this presentation here, ABC L plus 2 point actual loan, he wants to remove this L, that L is inflow 7.5. His objective was to arrive at what? Fixed cost, and fixed cost will arrive 7.75. Sir, if directly he would have got 7.75, then there was no need of this. Since he did not get, he'll do 7.5 plus what? 0.25. Now check once this part. I'll speak out with you. Read this part first. So he wanted a fixed, but he was able to get floating, and he converted into fixed. Now try to understand, please. I have given in the words also, so that becomes easier. ABC Bank wanted a fixed rate funding. ABC Bank wanted a fixed rate funding, but able to get a floating rate. The problem was he wanted fixed, but he got floating. To convert his floating rate funding into fixed rate funding, he enters into swaps such that he pays fixed and receives floating. Question did not mention you have done from your side, because your objective was to reduce what? Floating rate. Effective cost will become 7.75. Problem which comes here is, student says, sir, when he is doing, then should he not take L plus 2.25 as floating? It's not. He has given L, it's okay. His problem was not 0.25. His problem was only L, LIBOR. That means that was the only problem he has. He wanted to remove that L from the structure, and since question specifically mentioned that he can do a swap of LIBOR versus what? 7.5. So he has taken as an inflow. Sir, how do we know it's an inflow? Because if this was outflow, this is actual. To remove this outflow, this inflow will get cancelled and automatically comes out. So first part will not have a challenge. Read the first part, then I'll speak to you about the second part. I have given the wording. All in cost would be treating 6 months, exactly half year he has given. I have treated 6 by 12. How many year swap he is mentioned? How many year loan was there? 5 year. 5 year, na? Okay. First line was very important. Again, I am re-emphasizing. He wanted a fixed rate funding, but he was able to get floating rate. To convert his floating rate funding into fixed rate funding, he has done the swap, and that gives him first part answer. Let me go to the second part now. Let's go back to the second part. In the second part we have, he says another possibility. Now second option. One option is what he has done on the top. Another option, possibility being considered is the issue of hybrid instrument, which pays 7.5 for the first 3 years and LIBOR minus 1.4 for the remaining 2 years. It means, sir, now what he has done is he has taken 5 year into 2 periods. So ABC said it's 5 year into 2 periods. In 1 to 3 years he'll pay how much fixed? 7.5. He wanted fixed or floating? Fixed, and he is getting what? Fixed. No challenge to you. Second, he is getting L minus 0.25. His problem is not minus 2.5 or 0.25 or plus. His problem is this to remove. That means to remove this, if this is his outflow, he should take a contract again, what has been done on the top, in which he should receive what? L as an inflow and pay what? 7.5 as an outflow. So this will be done for which year? 4th and 5th year. If I look prima facie for 4th and 5th year, what swap he created in the first part can be even created for the this part. In this case, L will get cancelled and his cost will become 7.25 for 4th and 5th year. So prima facie it appears problem has gone. The prima facie it will appear problem has gone, but it never happens. Once you have some operation surgery and they give you the BP medicine, it drops, it goes up. Sugar medicine, it drops, it goes up. Again some medicine, again some medicine. There has to be multiple cases comes. You have not experienced. I wish no one experiences that. But in movies you will see one surgery. If one thing is corrected, second goes for a toss. One problem comes, second goes for a toss. Exactly same thing will happen here. Exactly same thing will happen here. When you're trying to remove, if I look at, and I've given in the wordings also so clearly that even a layman can understand, hybrid instrument, that means second option. Prima facie there appears no problem in the first 3 years because ABC wanted fixed rate funding and they're able to get what? Fixed rate funding. But there arises problem in which year? Fourth and fifth year, because they're able to get floating funding for fourth and fifth year. To solve this problem, ABC Bank can enter into a swap such that floating rate funding can become fixed rate. Exactly same thing. Actual loan was taken L minus 0.25. Take a swap in which L inflow, this outflow with the swap bank or any bank you can say. Effective cost of the fourth and fifth year would be outflow L minus 0.25 plus 7.5 minus inflow, and net becomes what? 7.25. The moment you do this structure L 7.5, this is for 5 years. This is for 5 years. You cannot do fourth and fifth year. It's not an FRA. You cannot do the fourth and fifth year. This is a 1 to 5 year. So fourth and fifth year the problem has gone. Now the moment I go and take this part here, look at this. By taking the swap, the following problem arises in the first 3 years. First 3 years, what was happening? Actual was what? 7.5. But since he created his structure in which he was receiving what? L inflow and 7.5 outflow, the effective cost for first 3 years will be L, this outflow, and this what? Inflow. So it becomes 15 minus L. The problem occurs in the first 3 years. Understand please, in the first option, it was directly 5 year, problem went. Second option, first 3 year is fixed, problem was not there. The fourth and fifth year had the problem, but to solve the fourth and fifth year, he took the swap. The swap cannot be taken for fourth and fifth year, the 5 year swap, which created a problem of this structure in the first 3 years. Question was not beautifully framed. I am saying it again. Next time again the same will come, and that is why the feeling comes in. Then he says, we read till here, na, this full stop. I am reading, given a 3 year swap rate of 8%. Given a 3 year swap rate of 8%, suggest the method by which bank should achieve the fixed rate funding. Now, if anyone reads this question for the first time, they'll not even understand what exactly is happening. What is the meaning of this? 3 year swap rate means what? That means he is given that there is another swap of 8% versus LIBOR. He has not mentioned clearly, but indirectly feeling has been given that another swap is available 8% with LIBOR. Now, I know when I was doing my swap for the B case, I entered into a problem in which my first 3 years L came in, and L came in such a way which created L as what? Inflow. Which created L as inflow. Now, without I move forward and look forward or look at the difference point, I need to remove this L. L is what? My inflow or outflow? Inflow. Now, second swap which is available in the market is L versus 8%. L versus 8. He has not mentioned whether you receive L, pay L, etc. Now, you take a call what you will do. You want L to be removed. L in the first 3 years is inflow. That is by taking that 5 year. 5 year swap was taken because it removes the problem of fourth and fifth year. Now, to remove the problem of first 3 years, you have this option. You tell me in L and 8, L you will receive or pay now? Pay. The moment pay, that means you receive from here, you pay here. That will go. That means L you will pay, 8 you will do what? Receive. And 8 if you receive, it means L will get cancelled. 15 outflow, 8 inflow. Net cost will be 7%. So it means first 3 years will come, 2 swaps will be there, and percentage will come at what? 7%. And for the last 2 years, what we have? 7.25, which comes out. So if you look at my structure here, second part, if you look at this part here, in order to overcome the problem of first 3 years, which happened here, L plus L minus 5, which happened here, the bank will have to enter another swap such that floating rate goes off and it becomes what? Fixed rate funding. So basically what we had till now, this structure which was here, I have redrawn 7.5 outflow, 7.5 outflow, L inflow. This is new structure in which L would be outflow 3 years, 8% would be inflow. Now what will happen is L inflow, L outflow, L inflow, L outflow gets cancelled. 7.5 outflow, 7.5 outflow, that was 15 outflow, and 8 what? Receipt. Ultimately your effective cost will come as what? 7%. Effective cost will be 7. So hybrid instrument, if I put 1 to 3 years 7%, 4 and 5th year 7.25, which is cheaper than the first, so hybrid instrumentation is better off, which gives lesser fixed cost. In the first case it was entire 5 years, second case first 3 years were fixed, say last 2 years were floating. To remove the floating problem, objective was to remove this floating problem, swap was taken, but the moment that swap was taken, it created a problem for which year? 4th and 5th year. To remove that swap, we have taken another swap which will remove the problem. Now you have to understand, whenever you are taking something, why in the first swap sir L was inflow? Because L was outflow here. So to remove that, L was inflow. Now in the second case, since L became your inflow, to remove this inflow, the second option which you have L at 8%, L should be what? Outflow. I hope things are clear. So this could repeat. It's almost, I think, 15 years now. This has not come. So this could come back and you'll face, now while reading it looks prima facie easier, but in exam the mind might not work. Maybe based on this he can modify slightly and then give you the question on that. Just quickly go through the question and answer if you want, and then we'll do small exercise which we have here. This was swap technical part of it. One very basic question which comes in exam very often is OIS, overnight index swap. Is OIS. It's overnight index swap. It's short term swap, basically a very short term swap in which one party pays to the second. We call it as one leg. This is called second leg. One will pay floating and second will pay fixed. And the few objectives are there. Which question will mention? I think MIBOR in the OIS is compounded daily. That means if for example today is the rate and tomorrow some rate will change, because in MIBOR is Mumbai Interbank offered rate. It's like LIBOR only. If the floating rate we are giving, then floating rates will change every day. So if first year interest will calculate, then next year will become principal plus interest and then calculation. Then principal plus interest and then calculation. That means MIBOR in the OIS would be compounded daily, whereas in a fixed leg you'll just take the 7-day period and do the calculation. And if there is a holiday, for example, if any holiday comes in, so the rate of the Saturday and Sunday can be combined together and apply it accordingly. So let's look at the question. We'll understand the flow. It's a short term swap. One leg is fixed, second is a floating. Over the MIBOR is compounded daily, and the in case of holiday, previous day MIBOR can be assumed for the next day. Derivative bank entered into plain vanilla swap. Plain vanilla is one leg is fixed and second is floating. On a principal of 10 crores, agreed to receive MIBOR. Agreed to receive MIBOR. Now that means derivative bank has agreed to receive what? If I put here, if I put derivative bank, and there could be some another bank which is here. So if we have one bank is derivative bank, so we say derivative bank has agreed to receive MIBOR. That means he'll receive floating. If he's received floating, that means he'll pay what? Fixed. So this structure should be clear. Overnight floating rate for the fixed payment on the notional principal. The swap was entered into on Monday 2nd August and was to commence on 3rd August and run for a period of 7 days. The rates from Tuesday to Monday are, it's a Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, and then Monday. Sunday was a holiday, so 7.98 will come. So Tuesday rate would be 7.5, 8.5, 8.12, 7.95, 7.98, 8.15. If derivative bank received 317 net settlement, calculate the fixed rate and interest under both the legs. Note Sunday is a holiday. Work rounded off fees, avoid decimal places. Now what he has given is, derivative bank will pay the swap bank fixed, and this bank will pay MIBOR. MIBOR we know will be compounded daily, we know the rates, and he says we do not know the interest under both the legs, but we know when the settlement happened, the derivative bank received what? 37 more. That means if this was X amount, this will be what? X plus 317. If one paid X, since if I'm a derivative bank and I received 317 more, it means if I paid X, while receiving I would have received what? X plus 317. So that's the receipt. Calculate the fixed rate and interest. Now since we know the interest under the floating rate, we can calculate if 10 crore is the principal. MIBOR is how much? 7.75. Rate we can apply. Sir, how this calculation is done? You can show the calculation. 10 crore into 7.75, you can do this way. 10 crore into 7.75 by 100 into 1 by 365. So next day this becomes the amount into 8.15 into 1 by 365. This becomes. So you can calculate the interest under the floating rate easily because rates are known, and then Sunday was holiday, so you calculate this way into this, and I think that is 2 by 365. This amount you get. Done. You get this amount, and then you have on Monday that comes it, and this total amount is nothing but, sir, this total amount is interest under what rate? Floating. And we know floating when he received, this was equal to X plus 317. If this was X plus 317, can I reverse calculate the X amount? Yes. So my X amount would be equal to what? 153,423. X amount was 153,423. So we get fixed rate as equal to, and then once we get the fixed rate, then we calculate 153 the 423 by 10 crore into 365 by 7, 8% comes in. This was the objective of the question. Quickly check once, please. Quickly check out once. So basically he expected you to calculate the rates under both the legs. Done? So this was another type of question which came. Now one part I think you can try, or give me times. Hmm. So one small video I'll not do it. You can see from the YouTube if you want. It's cheapest to deliver. If you know, it's fine. Otherwise, you can go and watch that video. In fact, those who are are on the group, I'll send them separately. But otherwise, you can see from the YouTube, my channel I have. No need to subscribe, because once becoming CA, there is no use unless and until I make videos of the markets. Now, this is my photo only. In this, I don't know how to find that video. How do you find? I'm very new to the YouTube. So you have something called videos here. Acha. Oh, so many. Oh my God. These are my photos. There should be cheapest to deliver. Interest rate futures. Okay. Interest rate futures. Interest rate futures. I know I have. Also, you can do one thing. There is something called tracking error by chance. If someone has done it's okay. Tracking error. You can put down that word also by chance. By looking at this, I came to know. Tracking error also you can do. That's part of the mutual fund. If you have done, that's fine. So tracking error is also there. That you can see one. Interest rates we have done. Cheapest to deliver will come. I know how it comes. I don't know. It's how do you? Just type in when you go back home, na. Just type in cheapest to deliver. Huh? Where is it? There is. Yes, and that will be in English and Hindi both. So depending on your language, you can do. I think this is Hindi. English would be there. So you can just go back when you go back home. Just type in this topic cheapest to deliver. I think it has been, the video was made before this topic came. This topic has come I think a year back. So I made this video 2 years back. So exactly same thing would have come. It's means that exactly on the similar line question has come. It is not tough at all. But some of you who has not seen, for them should see that. Please, if he has given once, there could be possibility he'll give second time. So just you can just copy that when you go back. You can watch that. Someone wrote me yesterday, make a playlist. Now what is a playlist? I don't know. I tried today. I messed up. I don't know how do you make a playlist in a club. So I'll try whatever classes are taken, because it's good they asked playlist. I thought someone will ask then, sir, how do we remember it? Or you make a food on my behalf, and you eat also on my behalf. So everything I don't know, because we have become that ways only. It's okay, but I learned something new. Whosoever wrote, I don't know, but it was good. I learned something new. I'm not very habitual of this e-learning. It's very difficult. Natural life is always good. Normal life. I love. We go back to the blackboard. Just 1 minute I'll take. I have not taken any time of your nalaik anywhere. My in-laws by chance went to my parental home. Then means where I was born. It's very small village. They by chance in Rajasthan they went today, and I was so excited. They gone there. My in-laws, matlab my in-laws. You understand? My wife's parents, and they actually I have been brought up in a school in which you'll sit on the reeds, and I told them since morning I've been calling them, this is my school, you should watch. I used to jump from this window. There was no ceiling, so Whenever teacher used to hit you, I'll jump and come back in the half, and 2 minutes distance of a home and a school. Then the water harvesting you would have started seeing now. The village which I have, there was no water when I was born. After that, long time, till 10 years back also. Now there might be 2 days in a week water might come. Otherwise, there are what you call it as. We call it as kuwa. What do you call it as? I don't know. Wells. In my house, you know that built up is how water is below, that is stored. What comes on the English is very difficult to explain now. Like you terrace, na terrace English terrace chat. Water comes. It is such build up. The water is stored. It will go down, and that throughout the year we drink that water. It's always neat and clean. Inside that's I think tuna or something. They mix it accordingly. Then if there are two houses, what they do is from second house some tunnel would be connected short way, which can be removed and put. There's a put from that also water comes. It's stored. So it's a very small village. Still we have that concept. So I was so excited, and I think I naturally love those things, this high tech, etc. But I told them, when you're there, just click your videos out of that room. That is my room, but it is closed for a long time. So feeling came just now. So it's by chance came in because when looking at these high tech world, when I see my kids playing the phone, although they play very less, but when they play, I think we have moved into a very different kind of a world. Means where natural beauty has gone. Evening they were going, you know what? We here find camel rides, camel rides. That's very common there. So I told them we should go see the camel rides, and some sweets come. I asked them that is made only there. When you're coming back, bring for me. I was by chance busy with your batch, else I would have gone for 2 days. Since 7 o'clock I've been calling them again and again. This is this. There are kacha roads only. There is no Paka road. It's kacha road. You've not seen. I went with a couple of teachers from Delhi, some well-known teachers. We went to Rajasthan for a trip, and by chance it was coming. I took them. They were surprised. It's almost 2018 or 19, I remember. They were surprised. Still, we in India we have such a village. I said this village serves 20 more villages. My village is still much bigger. So we have that beauty, and it's natural. And I told them from the house that now evening they have gone for what you call it as mitti what comes in. They have no, the sand, what you call it as mountain, sand mountains, what you call it? Huh? Whatever you call it as, mitti tili, we call it as, it's mitti only. It's natural, you can play. It's not like this. This is a different kind of mitti only. So they have gone for a ride. I told them where you go for a ride. We used to go early 5 o'clock till that 2.5 kilometer, 3 kilometer for to get our milk. Go there and come back. So it's something which was very interesting to see. I told my mother also today, we should go for a holiday in Nalaik. We are sitting here in the city every day, cars, etc. There is no car, there is no bike, nothing. 7 o'clock you sleep, 5 o'clock you get up. That life is so beautiful. So this YouTube world, etc. has made us, actually, we have become so very keen on knowing someone else, what is he doing, and then we start doing same thing. Hey, we are not problem. We don't have problem because we don't have anything. We have problem if someone has. That problem comes in. The moment you start watching, etc., that's the problem which comes in. But whatever is your native place, I still see some connection of the people from here. Students here, when they come from that side. They go back on the holidays. I feel how nice it is to go back. My village is very far away, but it's something in the high tech world. Do not forget your basic things. That always will remain. Because I have studied only there for a few years only, but I still remember teacher used to scold me, and when he used to scold me hard, I used to jump from the window and come back home. So I still remember those days, which are still, it cannot go. So anyhow, the objective was not that. Objective was I don't know how to operate, so I have just told you this is my photo, and you'll see a lot of photos in that cheapest to deliver. You can see that. That was the objective. Coming back to it now, like let's come back. Now that's our interest rate risk management working we have finished. Now can we move to, we'll start capital budgeting, which is new for you. Now before I start, can I take 15-20 minutes of yours to make a base work? Means because I'm assuming you might have forgotten. My objective would be I'll try to cover the chapter in such a way that we have touched almost every relevant thing. Means not going into, because otherwise at 70-80 questions what we cover, more than that we cover in the class. So I'll cover the question in such a way that topics which you have seen, basics plus what could be this, what could be new, and something will come. Although you will not face that challenge if you would have done the capital budgeting in your inter level. So I'll just quickly go back and do some basic stuff with you so that it help you revise. IRR is one of the very important parts will become. Just going back to your inter level, although I do the same thing in the final but at a very fast pace. In capital budgeting, the objective is to take a decision whether to accept the project or not depending on the cash flows. Time value of money is very important part here, and the objective is, are we able to cover our cost of capital or not. CFAT depreciation used to be important term. Two methods of depreciation, WDV and a straight line method. Capital budgeting techniques, one were discounting, second one non-discounting. Non-discounting techniques are hardly used now. They were just part of the theory purpose in the inter level. Non-discounting were 100 rupees today will be 100 rupees every year. The methods were payback period and the accounting rate of return. Use of time value of money, most used method is NPV. NPV is actually a wealth maximization concept. Wealth maximization we call it as, for example, if any company announces some project and if by chance the share price of that company goes up, what happens is the market is so matured, they do the analysis that if this project comes in, these will be the cash flows, they discount back, minus the cost, whatever amount comes, divide by the number of share outstanding, that is the increase in the share price. So that's NPV is nothing but a wealth maximization concept and the most used method practically. Then second most used method is IRR, internal rate of return. It's a rate of return what you earn. This is in the amount term, this is in the return term. Then we have payback period. I've just taken the small examples for the normal class purpose. Payback example is how many years your money would recover. If you have a same stream of cash flow, you used to apply a simple formula. If there is different stream of cash flows, you used to do cumulative cash inflows and then accordingly apply the formula. Accounting or annual rate of return or average rate of return was based on the initial investment or based on the average investment. It is the only method which is based on the accounting profit. Rest all methods are based on the CFAT cash flows. Then total profit for, and I have taken just example, it's okay. Discounting technique, this was important. Understand the flow of it, because while doing questions, some of them might come handy to you. Discounting technique, net present value, objective is inflow, compare with the outflow. Time value of money is important. We have to bring back to the zero period. So when we bring back zero period, we say PV of a cash inflow minus PV of a cash outflow will give me the NPV. If NPV is positive, we accept the project. If NPV negative, reject the project. The discount rate used to be the cost of capital, because that means you have to recover at least the cost of capital when you invest in some project. And then profitability index was inflow by outflow discounted. Payback period was normal. Internal rate of return is very important. So get the clarity. If you have the clarity, fine. Otherwise, get a basic clarity of it, because I straight away start from the technical questions of the IRR. Internal rate of return. This is a company. Actually, if you look at balance sheet, in the balance sheet you have a liability and the asset side. When we are standing on the liability side, that's investor has given the money. I have taken, company raises the money, company will invest in the money in the project. That's a capital budgeting decision. When we are taking a decision on the IRR, you have cost available here, you have a return available here. Till the time your return is greater than the cost, you accept the project. If the return is less than the cost, you will not accept the project. That was the objective. Now, problem IRR is the definition which is given mathematically. There is problem with the mathematical definition, because mathematical definition is created in such a way which does not tell us to take decision on IRR, but it tells you to calculate IRR. And by chance, the way it is given to calculate IRR, you end up making a mistake. Understand what I'm saying? If you tell someone, my fund is raised as 10% and I'm investing in a project which is giving me 15, you'll say what? Accept the project. If fund costing is 20 and return is 15, do not accept the project. This is exactly what you'll say. Yes. So we say decision is IRR greater than cost, accept. NPV would be positive. IRR less than cost, reject, NPV would be negative, PI less than 1. IRR equal to KO, NPV would be 0. Actually, mathematical definition is to calculate IRR is that rate at which NPV becomes 0. The moment I use this word, IRR is that rate at which NPV becomes 0, the student starts saying that means, sir, indifferent project. It is not indifferent. IRR can only be calculated. For example, I might have taken some data points here. Yes, I have taken data points. IRR is that rate at which NPV will become 0. It does not mean that project is indifferent. To take a decision on IRR, you need to compare IRR with cost of capital. I'm saying it again. To take a decision on IRR, you need to compare IRR with cost of capital. For example, why I'm saying mathematical definition again and again, because whether I teach at inter-level or at your level or any higher levels, I would have done this concept. Everyone has that notion of the mathematical definition. They'll say IRR NPV is 0. NPV is just a term, net present value. Net present value can be calculated by discounting the cash flows by any rate. When we say I have to take decision on NPV, then my discounting rate is KO. If I take IRR as discounting rate, still my NPV would come. That NPV would come 0. Reason being, if I stand here and I take 10 steps forward, if I come back 10 steps backward, I'll reach at same place. If I earn at 10%, if I discount at 10%, I will come back always to the same place only. So my NPV would be 0. Actually, why mathematician gave this definition was, for example, if you look at this data, the data above data says 50,000 inflow, 50,000 inflow, 50,000 inflow, and 1 lakh is outflow. Data says I do not know what is my earning rate. Mathematician said not to worry. You would have earned by some rate and then you would have reached at 50,000, 50,000, 50,000 in 3 years. Since you do not know your earning rate, do one thing. If you are standing 1 year, come to 0 period. If you are standing 2 years, come to 0 period. If you are standing in 3 years, come to 0 period, and calculate a rate which brings all three of you at 0 period and makes you equal to what? 1 lakh. It means your earning is as good as the discount. This rate is as good as the earning rate. So what does it mean? For example, let's suppose from the home, this is a modified car, new car. In this car you go for a marriage function, and when you went for a marriage function, generally have a habit to note a distance how much we traveled, but by chance you forget the traveling distance. Then some advisor would come and tell you it's okay if you don't know. Whatever distance you will go back home, same distance you would have traveled from what? Home to this place. Exactly same thing. So if I go somewhere, let's suppose I come from my home Amirpet and I missed out that how much distance I traveled, I do not know. Then I'll do what? From here when I start, I'll note down the meter, and when I reach home, I look at the meter, I'll say if I'm going back it is taking 10 kilometers. That means this way also I would have come what? 10 kilometers. Exactly same thing. If you have 50,000 earning, let's suppose 50,000 earning in second year, 50,000 third year, and you invested 1 lakh rupees, you don't know what rate you earned, then advisors are telling you come back to this, become equal to this, come back at same level. Whatever rate you come back, that was your earning rate. Now that means the rate which will come will always make your NPV 0. In fact, I should use a language, since your NPV is becoming 0, hence you are able to calculate IRR. If for example I tell from my home I can come here only, but I cannot go back. If I cannot go back, that I cannot know how much distance I traveled. Since I can go back and I'll reach at the same place, I know that my earning rate can be calculated. So this will be earning rate. Then sir, if NPV is 0, it is indifferent. No. If NPV is 0, then you look at what was your cost of raising fund. If your cost of raising this fund was 8%, let's suppose, you'll say accept the project. But sir, NPV is 0. NPV is 0 for the purpose of IRR. When you take calculation for the purpose of decision making, your discount rate would be what? Cost of capital. Understand the difference I'm saying, please? For when you take a decision on net present value is only discounting and calculating the present value. Actual criteria of doing is, if you have a risk-free cash flows, risk-free discount rate should be used. If you have risky cash flows, risky discount rate should be used. If you have, let's suppose, equity cash flows, equity discount rate should be used. We have done in the M&A, for example, some of them. Similarly, when you calculate the present value, discount rate is cost. That is for the purpose of decision making. But when you have to calculate IRR itself, IRR can only be calculated when I make these cash flows equal to what? This cash flow. That is called my IRR. At IRR, NPV would always be 0. That does not mean that it's indifferent for the decision making. It's only we are coming back to the 0 period. So this data, when we look at this data, we say mathematically we say at IRR, PV of a cash inflow would be equal to what? PV of cash outflow. By using this equation, we will be able to arrive at IRR. So cumulative, how do we use, sir? Basically, we calculate two rates. Either they will be given in the question, 99% they will be given in the question. If they are not given, any two rates of your choice, at one rate positive, at one rate negative, and then apply the interpolation. But problem happens is when you have a difference in the rates, your IRR would come, approximation will increase. For example, if I stand here and ask you how far this door is away, it's only 10 steps maybe. The moment I ask you my office, you will say 50, 70, 80, 100. Where my activized part will not be able to tell. Exactly same thing. When we use two rates, ideally two rates should be used such that they are back to back each other, consecutive rates, 13, 14, one rate positive, one rate negative, and then solve. Otherwise, if question says 10 and 20, you should take 10, 20 and solve. Your answer would be approximate, valid for the exam, because the objective of the exam is not the exact calculation. It is the approximation, it is the formula. It is the basically they want to understand from you the process understanding. Third, if they do not give, then they'll give table. If they do not give, hit and trial. That means any two rates of a choice, use and do it. Although there could be some methods of calculating the approximation rates, but that anyhow has not been required till now. In my question, there could be possibility I might take you back to the annuity table to help you the process. I'll show you how a question comes in the exam. The table is given in the book question itself. So do not worry on it. I'll maybe helping you out with the annuity table or something of a table that how inflow equal to outflow, and then so do it. So that's the IRR which comes out. So let me go back. IRR is basically, so I'm not doing a basic question. We'll straight away move to a technical part of it in which IRR will apply. That means our objective is PV of a inflow should be equal to PV of a cash outflow. When we say PV of a inflow is equal to PV of a cash outflow, it's annual CFAT. When we say this PV of inflow, annual CFAT into what, sir? Annuity factor we apply, and should be equal to the PV of a outflow. We would know this, we'll try to calculate this PVAF. And how do we calculate? That we will learn with the time and the process. So let me go back. Let me see if I can do some basic question with you, so that you will get the flow of it actually. Actually, I have given you directly equity IRR and project IRR. Basic process if we once make, yes, let me show from my book only, no need to worry. This is how exactly the question should appear to you. 10th question we are reading. You will not have the 10th question, don't worry. This is a basic purpose for the IRR I have taken, so that students are comfortable how to calculate, and then we'll move to the technical side of it. Company proposes to install a machine involving capital cost of 3,60,000. Capital cost of 360. The life of the machine is 5 years. Salvage value at the end of the year is life is nil. Machine will produce the net operating income after depreciation of rupees 68,000 per annum. Produce operating income after depreciation. Profit after depreciation. This will be profit after depreciation. The company tax rate is 45. Net present value factor What are these, sir? This is actually a summary of the table. Calculate the IRR. Now I know at IRR my inflow is equal to outflow. Outflow I know is 3,60,000. To calculate that inflow I need annual CFAT. Annual CFAT would be, this is given to me as what? PBT. 68,000 is not CFAT. It's operating income after depreciation. So I have what? 68,000 PBT. I have 68,000. Subtract from here what? Tax is what? 45%. So 45% tax you subtract. When we subtract 68 minus, you do 55 directly. 37,400. So you get 37,400. Depreciation would be equal to 3,60,000 divided by 5 years. How much? 7, 8? 72,000. So your CFAT would be 37,400 plus 72,000. 1,09,400. So it comes this way. First part I'll do is calculation of annual CFAT. 68 minus tax, PAT, add CFAT. Now we say at IRR. PV of a cash inflow is equal to PV of a cash outflow. Annual CFAT, that's 1,09,400 into annuity factor should be equal to what? 3,60,000. Now annuity is not known. This percentage for 5 years is not known. When I do 3,60,000 divided by 1,09,400, we get 3.29. Understand the meaning of it. It means I need to find such two rates. I need to find such a rate. If I discount the rate for 5 years, the sum of it should be equal to 3.29. Or I can say the 3.29 is nothing but annuity of the IRR for 5 years. Basically, this what I am getting here, present value annuity factor, which I am getting here, is representing, it is IRR, sir. How do you know IRR? Because we have taken at IRR in such a way that at IRR inflow should be equal to what? Outflow. And if I want to calculate this rate, we say 3,60,000 divided by this should be equal to 3.29. 3.29 is nothing but summation of present value factors of IRR for 5 years. Now how do I know 3.29? How examiner will give you is this way. He will give you this way. He will say 14% rate, annuity is 3.43, 15% 3.35, 16 3.27, 17 3.20. Your rate is falling what? 3.29. It falls between what? 15 and 16 percentage. So you used to select what? You used to select two discount rate. They were 15 and 16. Then at 15 and 16, there could be a different way of doing it. I have very general way of doing it. At 15, I calculate my NPV. At 16, I calculate my NPV. At one rate, NPV is negative, positive. I want to go at what? 0. And then we apply what? Interpolation. That means 15 percentage NPV. We are standing here. We need to cover this distance 6490. Difference of these two is 87852 into 1%, and that gives me the IRR. That's called interpolation. So we apply lower rate plus lower rate NPV, lower rate plus lower rate NPV divided by high rate into difference in rates. That is exactly what we do. That is how what it comes. This was the basic IRR. I hope you are able to recollect. Nothing but you need CFAT. CFAT into annuity factor is the outflow. So you want annuity. That annuity is nothing but that annuity represents that we need the rate which will give me a sum equal to 3.29. This was your basic question which generally we cover in the interlevel. Now coming to the question what I have given a project IRR and equity IRR, which I am expecting should come to your exam, which will test your intellectual level along with the objective of the IRR. 11th question, read once please quickly and mark it as important. 11th question. Read out. Question number 11. Read once, then I'll read out with you. Let me read out. It says XYZ Limited, an infrastructure company, is evaluating a proposal to build, operate and transfer a section of 35 kilometers of road at a project cost of 200 crores to be financed as follows. That means there is some road has to be built, and they'll operate for some time and they'll transfer after some time, and cost involved is 200 crores. Financing is as follows: equity share capital 50 crore, loan at the rate of 15% per annum from financial institution 150 crores. The project after completion will be open to the traffic and a toll will be collected for 15 years from the vehicles using the road. The company is also required to maintain the road during the above 15 years, and after the completion of that period it will be handed over to the highway authorities as zero value. It is estimated that the toll revenue will be 50 crore per annum. That's a revenue figure now you have. This will help in calculation of CFAT revenue. Annual toll collection expenses including maintenance of that road will amount to 5% of the project cost. The company considers to write off the total cost of the project in 15 years on a straight line basis. For corporate income tax purposes, the company is allowed to take depreciation as 10% on WDV. The financial institutions are agreeable for a repayment of loan in 15 annual installments. This is equated annual installments consisting of principal and interest. Calculate project IRR, equity IRR, ignore corporate taxation. Ignore corporate taxation. This is an important line, because if you ignore depreciation, taxation, depreciation becomes useless. Otherwise things would have been slightly complicated, because then you will use something of a called leasing or a hire purchase, in which you'll do segregation of a principal, interest will save tax, and life would have been slightly difficult. Explain the difference in project IRR and equity IRR. Now understand the objective of it. He says there is a road which will be running for 5 years, then that road will have some income, there will be some expenses coming in, and the costing of the road would be 200 crores. The 200 crores costing means basically the 200 crores will be spent. Out of that, some amount will be spent in the equity and some would be spent on the debt. Then he says whatever debt you have, the debt would be repaid in how many years? That debt would be paid in the 15 years. So you'll be repaying the debt in the 15 years time period. So if I try to look at my data here, look at the data here in the slide format, I would have given it to you. Yes, if you look at on the slide number 2, what we have, we call it as the project cost is 200 crores. Out of 200 crores, equity share capital is 50, loan is what? 150. Now if you look at the loan, and he said loan, how much you will repay? How much loan you will repay? 1 equal installments. How many years? 15 years. Interest rate is 15, time period 15 years. So we calculate equated annual installment. Now how this formula comes, sir? Actually we have been using only single formula. Let's suppose if I give you 1 year, 2 year, 3 year and so on for 15 years, I am standing at 0 period. There is equal installments here. There is a equal installments here. There is a equal installments here. You bring it back to 0 period. You will multiply by what? Present value, annuity factor, and that will become equal to what value? 0 period loan value. Now that means if I apply, my formula would be equated annual installment into annuity factor should be equal to the loan amount or 0 period amount. So when I divide by this, now I divide by this, I am getting a equated annual installment. Equal installments basically I am getting. So when we are getting a equal installments, we call it as, or equal installments would be equal to loan amount divided by what? Annuity. Every year I would be paying how much? 25.65. So why this becomes important? This becomes important because it will help you knowing cash outflow. It will help you know cash outflow. And second reason of knowing is, you want to calculate what? You want to calculate how much cash has been invested by the equity holders, how much cash has been generated by the equity holders, how much cash has been spent by equity, debt, both, and maybe both of them are earning. So in this case, first part was my project cost is 200 crores, equity 50, loan of 150, and this includes, when you're dividing by this annuity, how do you calculate actually equated annual installment? You calculate loan plus interest, and that gives you equated annual installment. So when you calculate this now, when you calculate, this is also including what amount? Interest amount. Since question said tax ignore, it means it has saved lot of your time. Otherwise you would segregate this on depreciation also, you'll calculate the taxation. Only one question could have been done in lengthier time. So beautifully framed question, and it gives you the advantage of comparing the project and the equity IRR. You can say it's a firm earning and it's a equity earning in simple language if I say. So this becomes my 25.65. How do I get, sir, project cash flows? Revenue was what? 50. How much he has given expenses? 5%, 10 crores. Project cash flow becomes what? 40 crores. So I have a project cash flow 40 crores equated. When a project is giving me 40 crores, when I subtract my installment, it includes principal and interest both. So if you subtract your debt component, interest component, you get money for whom? Only for equity cash flows. That means project cash flow is 40, equity cash flow is what? 14.35. And should know, if I am calculating return for the equity, it has to be compared with the equity cash flow. If I am calculating project for the return, project cash flow. Now when he says calculate what? Project IRR, we say at project IRR. Our basic nomenclature of IRR is inflow would be equal to outflow. We say PV of, and I am using my words, I have used my words very very carefully please. It's PV of project cash inflow should be equal to what? Project cash outflow. Do we know project cash inflow? 40. Yes sir. Tax was not there, it has saved our life. Into annuity factor percentage 15 years, which we do not know, should be equal to project cash outflow. How much is your project cash outflow? 200 crores. I get some annuity. Annuity comes 5. Sir, how do I read 5? And I have written the words also. Look in annuity table under how many years? 15. They would give you in the book. I'll show you how they give. One I have shown. Again the examination question I'll show you. This question I have taken from my side. So maybe I have not given the data. I'll show you the annuity table. Now sir, how do I read 5 here? 5 is nothing but we have to find such rate whose discounting factors, when we add up, it gives what? Sum as 5. Exactly same thing IRR used to do. Now I'll try to find and look in annuity table. So when I go back, I have given you annuity table at the end. So if you go back at the end, in between I'll show you something else also. If you look at, just look at question number 71. In this also we'll be using IRR. That's the sensitivity analysis. They give you like this factors. They will give you. I have not given to save, just to show you that how, if by chance they attach that annuity table all together, then what you'll do. So at the end of the pages, I would have given you annuity table. How many years? 15. So we'll go at 15. This I'll stand here 15. And these are years, and in between we have what? Rates. I want to see sum of what? 5. So in the 15 I see 5, 5, 5, 5, 5, 5, 5, 5, 5, 5, 5. Nothing comes. So till 10% nothing comes. Right? 15 years you go right. Anywhere 5. What happened? No. Then I go next page. Then I have rate 11 to what percentage? 20. I again, how many years? 15. Under 15 I have to see what? 5. And that sum of 5 should be of a rate. So I have to reverse calculate that rate. Na? That 5 should be of a rate. 5, 5, 5, 5, 5, 5, 5. It comes 5, but 5, 5, 5, 5. 18 and 19. That means two discounting rate should be 18% and 19. This gives me 18, 19. That means I'll solve at 18%, I'll solve at 19%, and if NPV becomes positive, negative, interpolation is not the patent right of IRR. It just helps you calculation of the between using, it's a unitary method actually. It's a unitary method which comes out. So when I go back here, I go back here. So two rates are 18 and 19. So 5 falls, that means the 5 will come as a cumulative factor of any rate between 18 and 19. So I calculate NPV at 18 percentage. You can quickly calculate on the calculators, keep calculating. 40 into 5.092, you can take that rate, or annuity of 18 percentage you can take 5.092, or you can pick from the book also, that's fine, perfectly fine. At 19 I have 40 into 4.876, so NPV comes 3.68 positive, NPV comes minus 4.96 as negative. When I apply the interpolation, lower rate plus lower rate NPV divided by lower minus higher, actually it's a unitary method which shows how this formula is built up, sir. We are standing at 3.68, lower rate NPV, I need to move 3.68. When I move from this to this, my total distance is this. So if this is for 1%, I need to move only this much. How much is for that part? That's a unitary method we are applying. So my answer comes what? 18.43. Now sir, how do I need 18.43? It means on the project as a whole, I have earned a return of what? 18.43, and a project as a whole, that means equity and debt combined, and we have taken the cash flows of the equity debt combined, outflow also, inflow also. Now if I have to find equity IRR, do not switch over the slide, please do not switch over the slide and tell me what should I take, how should I write here. I'll write at equity IRR, PV of cash inflow from what? Equity should be equal to PV of a cash outflow from equity. How much is outflow of equity? 50. Outflow 50. How much is inflow of equity? 14.35. That means 14.35 into annuity factor of how many years? 15 years should give me equal to what? 50. So I have to find that rate. When I go back here, I try my PV at equity IRR. PV of a cash flow from equity should be equal to equity cost. This annuity factor, I want to find this annuity. It means I want to find 3.4843. That means I want to find such rate whose sum of 15 years should be equal to 3.4843 something. Look in annuity table under how many years? 15 years. So we go back, do the same exercise, 3.48 approximately, you can imagine. When I go back and want to see 3.48 under 14, till 20 it is not there. Then I go into the next slide, 15 I highlight, 3.3.48, very good, I am getting somewhere here, 28, and approximately it's coming 28 only. Approximately it is coming 28, but more or less if 4 digits you take, you can find accordingly. So my two discounting rates if I see are 28 and 29. When I go back and try to solve, actually it comes 28 only. Even if you solve, it will give you 28. Even if you try to solve, answer would come 28. That means your project firm as a whole has earned how much return? 18.43, and equity has earned how much? 28. Sir, why this difference comes? Actually, when you start your very basics of FM in the inter level, you do something called trading on equity or leverage impact of the financial leverage. There is a concept of financial leverage. By chance you are not able to recollect, that's the core of the FM, that why companies go for debt financing. Why company go for debt. In fact, when we were doing the adjusted NPV also, I was telling you that debt can add value to you. Now if you look at this example, will help you out, and I am assuming if institute has to make a beautiful question, this could help in the leverage concept, financial leverage concept, IRR concept, and have understood the capital budgeting also. Now if you try to look up, I have done in the rough work first. This is rough work, this work. Equity money how much? 50. Debt money was how much? How much was debt money total? 150. So I've taken 450, 50, 50, 50. I've taken 450, 50, 50. How much project as a whole you were earning? 18.43. That means equity, when you said in the first slide, how do you read, sir, 18.43? It means this is the money earned on the equity and debt combined. So equity money is only what? 50 crores. Debt money is what? 150. What I have done in the rough work to show is, equity 50, debt 50, debt 50, debt 50, equally divided. I have said all of them are earning how much? 18.43. Whatever is earned on the equity is mine. Whatever earned on the equity is mine. This example I do in the inter level also, but not by IRR, but by normal in the leverage. You are not able to recollect. On the debt holders money or with the debt holders money, I earned how much? 18.43. How much interest I am paying them? I paid 15. Balance left what? This is called earning from the debt holders money. It will go to whom? Equity shareholders. Similarly, this is earned from the debt holders money. Excess will go to whom? Equity holders. This is earned from whom? Debt holders money will go to the equity holders. It means equity on their money is earning 18.43, but they are getting the impact of favorable financial leverage. Favorable financial leverage in which they are getting benefit from 1, 2 and 3, and if you add to this it will roughly come 28. It will roughly come 28. Understand why is it so that as a project I am earning 18 point something and as a equity I am earning 28, because I am getting the benefit from your money also. After giving, I will give you only fixed of return of 15. Whatever is left will go to whom? The equity holders. I hope you are getting my point what I am saying. These are a very important questions which checks the knowledge of a corporate finance, and if I try to put in the statement form, I have done it here. Project IRR is 18.43. Excess earned from the debt holders money will go to whom? Equity holders. 18.43 minus 15 into 3 by 1, and that becomes what? Equity IRR. So more or less it shows that why there is a difference in the project IRR and equity IRR. That means we, as you were debt holders, I was equity holder. From your money also I am earning 18.43. My earning also 18.43. After paying you 15, whatever left is mine only. So that is increasing my wealth. That is the meaning. It means, is debt giving a favorable financial leverage? Yes, debt is giving a favorable financial leverage. So one IRR could be applied this way. IRR can be applied in different ways. I'll come back to subsequent parts also. So what we have learned is one form of the IRR in which this is actually more or less a part of a valuation. In the valuation we calculate amount. Here we have calculated the return. If you want to note down anything, check. In fact, slides are with you. Those are watching at home, they can download from the drive. Is fine. Now going back to the second part of the chapter, in which, before I move, in fact that I gave you first slide, which some of you might have done, risk analysis and capital budgeting in inter. That's exactly same thing has come back. Risk analysis and capital budgeting. So what they ask is techniques of risk analysis in capital budgeting. First slide I am on. This is first slide. This is part of the capital budgeting, which actually this was part of capital budgeting long back, then it went to inter, then it came back to final again. Some statistical technique, they are also the part of the risk analysis. Why do we call it? Does the capital budgeting involve risk? Yes. And because capital budgeting involves risk, we have to capture them. Probability shows, probability is basically if, but, that's a probable, that's a risk involved. Standard deviation, variance, COV, this we have already seen. Now conventional techniques we are talking about. First, the conventional techniques. There are two techniques, risk adjusted discount rate and certainty equivalence. When we say a risk adjusted discount rate, it means cash flows has a risk. Discount rate should be a risky discount rate. Cash flows has a risk. Discount rate should be a risky discount rate. Certainty equivalent approach will mean that remove the risk from the cash flow. If you remove the risk from the cash flows are risk free. Use risk free discount rate. Again I am saying risky rate, everything is given, no need to copy anything. Risky rate, risky cash flows. Risk free rate, risk free cash flows. This is how the techniques would be used. First I am covering is risk adjusted discount rate, RADR. I think third, fourth slide I would have given, yes. Detailed I have given you so that when you try at home, you will not face a difficulty of it. RADR. And these slides will become also important because there could be some points which can be formed as a MCQ again. I'll show you where. Risk adjusted discount rate. Under this method, risk would be adjusted at discount rate. Under this method, risk would be adjusted at discount rate. Means method itself says risk adjusted discount rate. That means whatever is the level of risk, adjust at discount rate. Higher the risk in the project, higher would be the discount rate. Means you see as a discount rate, we say higher the risk, higher the return expected. So higher the risk, higher would be the discount rate. Risky cash flows would be discounted by risky rate. So cash flows as a risk, apple to apple comparison. Discount rate will have a risk. It is as good as equity cash flow, equity rate, firm cash flow, firm rate, risky cash flow, risky rate. How to calculate RADR will be given in the question. Achha. Will be given. I'll show you how they give. RADR second could be, this is they used to use, they give the formula, but very rarely they give risk free plus risk premium they'll give. And third formula which I'll do in the question, there is another formula which is as per the KPM, which I have not given here. I'll be doing when I do the practical. Risk premium is the rate of return over and above RF. Investor expects extra reward for bearing extra risk. Higher the risk in the project, higher the risk premium. Lower the risk in the project, lower the risk premium. So these methods are very simple. If question comes in the exam, it's a straightforward question. RADR. Complication can come when they combine first and two slightly in the language form. So risk adjusted will adjust the risk at discount rate. What are the type of question which comes, sir? First variety of a question which used to come, which should not, I think now might not give. Question number, I think 15. Question number 15. If you look at the 15th question, it says determine the risk adjusted NPV of the following projects A, B and C. Net cash outflows, project life 5 years, annual cash inflow, the coefficient of variation. You know what is COV if you recall back? COV is a measure of a risk. It's a measure of a risk. So higher the COV, higher would be the risk parameter. So company selects the risk adjusted rate discount on the basis of coefficient of variation, and he will give this way. If coefficient of variation is, for example, first is what? 0.4. If this is 0.4, discount rate you should use is what? 12, and annuity factor is 3.605. If you have COV of a 0.8, COV rate you should use is 14. This is your factor. If it is 1.2, this will be 16. Cumulative, sir, what is this last part? Last is present value annuity factor. This is 3.605 is annuity of 12%. 3.433 is annuity of what? 14%. 3.274 is annuity of 16%. Now straightforward we can do. In fact, it's not rocket science at all. Straightforward we can do 30,000 inflow. Discount rate I'll use 12 because question only said the discount rate should be measured on COV. 30,000 into 3.605. This will give me what? PV of a cash inflow minus 1 lakh outflow. Minus 1 lakh outflow. How much do we get? How much? 8150. Second we get is what? It's 42,000 into 3.433. 40,000 in 42,000 into 3.433 and minus what? 1,20,000. 20, 21, 24, 186. Then we have, sir, what? Third one, 70,000, 3.274 minus what? 2,10,000. 19,180. These are the answers. This is first variety of it. This is first variety of it. So I have given the answer on slide number 5. Calculation of NPV. This is how we'll show if it comes. This is such small question that he can make as a MCQ in fact. One of them can be made as MCQ. A, RADR 3.605, 30,000 inflow NPV. This is exactly what we're getting. Yes, okay. Project B is better. Now, second variety of a question, which I think has come in the inter or maybe final ones, is the 17th. We look at the 17th, please. Read out 17th quickly. Read out 17th quickly. If you look at the 17th question now, it says new projects limited is evaluating 3 projects P1, P2, P3. Following information is available in respect of these projects P1, P2, P3. Cost is involved, inflows year 1, year 2, year 3, year 4. Risk index. So what is risk index? It's a riskiness parameter. You can assume as good as a beta, for example. Minimum required return 15, applicable tax rate 40, RF 10. So this will be exactly as of RF plus risk index into the 15 minus 10 percentage. Required risk adjusted discount rates. So the way of calculation of RADR, this formula would be equal to as good as CAPM. So when I find the RADR of this, when we calculate RADR, its RADR is RF plus risk index into required return minus RF. This gives me 10 percentage plus risk index into 5 percentage. If the risk index is 1.8, discounting rate is 19. Higher the beta, for example, the way you read beta, higher the beta, higher the risk. So this is exactly same thing which comes out. This becomes. And then he has given you the cash flows. Since first project has cash flows which are what? Similar in nature. If they are similar in nature, what we'll do is basically, since they were similar, PV of a cash inflow minus outflow will get this number here. Second project, the cash flows were different, we'll discount separately. Quickly do once please, because you are doing for the first time, so you should be comfortable doing it. Try out once quickly please. Quickly try out. Try out quickly please. Some of you might be doing it for first time. It's okay, try out. Done? only objective in this question was the calculation of RADR. I would not be surprised since it has been reintroduced as a chapter. So there could be possibility this question can come back again. Someone who is doing for the first time, these are new things only. If you were doing inter and final, then they are basically repetitions. Then second approach is certainty equivalent approach. I have tried to give exactly the theory which will help you to read and understand. Certainty equivalent approach. Under this method, risk would be adjusted at what level? Cash flow level. That means we'll reduce the risk from the cash flow level. Under this method, riskless cash flows would be discounted by risk-free rate. The objective is RADR is risky cash flows, risky rate, and certainty equivalent is risk-free cash flows, risk-free rate. When risk is removed from the cash flows becomes certain cash flows. The word is certain cash flow. Now look at what I have written. This will confuse you for sure in one language problem. Uncertain means there is a risk. If there is certain means no risk. I will write BCom exam, I will pass, no risk. So accordingly you prepare. Some of the students I have seen afternoon exam, morning they come to know which exam today, because you know we'll pass anyhow. CA exam, uncertain risk. Even 1 year before we do not know. That's uncertain. Uncertain means risk, certain means there is no risk. Now look at this again as summary. RADR risky cash flow, risky rate. Certainty risk-free cash flows, risk-free rate. Now how do I calculate certain cash flows? Certain cash flows are uncertain cash flows into certainty equivalent coefficient. He'll give you that. You can remember for the purpose, if certainty is 1, the coefficient which is confirmed case would be less than 1. 1 is probable. Let's suppose there is a probability, it's uncertain. If there is a confirmation, that would be a smaller amount. That's certainty. How do we calculate certainty equivalent, sir? It's basically whatever is the certainty divided by uncertainty. Uncertain is 100 and certain is, let's suppose, 90. That factor becomes 0.9. That factor becomes 0.9, and that is basically he will give you in the question. Now for this factor, I am not talking to one part which I will discuss when we do the question. Let me do it here only, because you will definitely have the problem in reading when we go further. Let me take this part here. There are 3 projects I am taking. 3 projects. Uncertain is 100 lakh. Uncertain cash flow is 100 lakh. Uncertain is 100 lakh. Uncertain means risky or risky, na? First project says 90%, 90 certain. Second says 80 certain. Third says 70 certain. Can you find CEC? How much will come? Now right, calculator using 9.9.8.7, 0.9.8.7. Now if I show you only 0.9.8.7, if only this is given to you, which is more certain? Or let me put in simple words, which has lower risk? Which has lower risk? I hope you are able to get 0.9. Why? Higher certainty, lower risk. Is that fine? So be on this only. When I go to the question, I'll show you. You will have problem. I'm 99% sure. Actually, they give these factors and then they want to attach with RADR. We'll attach that. Remember that higher certainty means higher of a certainty automatically means lower of a risk. So if a higher is the certainty, that means C factor would be what? Risk. I can put, if I want, higher CC is equal to less risk, or I'll dictate, don't worry, I'll dictate few points. Let us do the question first. Let's do the question first. In fact, I'll come back. Don't worry, I'll dictate a summary of it, because I have to link the RADR with the CEC. The prima facie question which comes important from this topic is, I've taken one. If you say, we'll practice one more after this, because these questions are simpler. The Globe Manufacturing Company Limited is considering investment in one of the 2 mutually exclusive projects. That means out of the 2 only one can be taken. Projects X and Y. which require cash outlays of 3,40,000 and 3,30,000. The certainty equivalent approach is used in incorporating risk in what? Capital budgeting. It means when he mentions something, na, it means you have to apply the risk-free versus risk-free only now. Even if you give risky rate, that is of no use. The current yield on the government bond is 8. That is what? Risk-free. This to be used as a riskless rate. Even if it does not say, will be using as a riskless rate. Expected net cash flows and their certainty equivalent are as follows. Now what he has given, project X, let's focus on project X first. In project X, these cash flows are always uncertain, and C factor is given. Sir, how do I read point 8? 1 rupee uncertain, 80 paisa is certain. 1 rupee uncertain, 70 paisa is certain. If 1,80,000 is uncertain cash flows, can I calculate my certain cash flow? How would I calculate certain cash flow? Multiply. Once I get my certain cash flow, that is as good as risk-free cash flow. And if it is risk-free cash flow, I'll multiply by what? Risk-free rate. Is it fine? I multiply by risk-free rate. So let's go back here. Let's go back and do the first part. You have the book in front of you. Just do the first part. Help me out whether you are able to get it. Just see the project X, please. In the project X, I'll write very carefully uncertain. Sir, how do you know those were uncertain cash flows? Because if C factor is given, you'll assume those cash flows are uncertain. Uncertain cash flow into C factor, certain cash flow. Uncertain cash flow into C factor, certain cash flow. Uncertain cash flow, C factor into certain cash flow. And then discount rate at the rate 8%. You get PV of a cash inflow, outflow, and that NPV is what? Negative. Similar you can do exercise what? Project Y. Year, uncertain cash flow, CE factor, certain cash flow, present value factor at 8. Check the numbers quickly, please. Do not read the next part. I'll read out with you. I'll do some working with you and then we'll read out that part. I'll do some working with you, then we'll read out that part. Done? Now look up please. Before we read the next part, let's put down something. If you want, you can put down or look at once. Uncertainty. Uncertainty. If uncertainty is higher, that means risk would be what? Risk is equal to higher. If uncertainty is higher, we'll say risk is equal to higher. If risk is higher, and if I was to use RADR approach, I'll use high rate or low rate? Higher rate. And if sir CEC factor were given, you know CEC factor would be what? Lower. Understand what I'm saying? Lower the certain factors, that means higher the risk. Exactly same thing we did 98 in 70. Second, we can say if by chance uncertainty is what? Lower. Risk would be what? Lower. This would be lower. If risk is lower and if I was to use RADR approach, I'll use what? Lower rate. I'll use lower rate. And CEC factors would be what? Higher. From here I can derive one sequence. Higher CEC is equal to less risk. Higher CEC, less risk and lower RADR, yes. Uncertainty higher, because these terms are very odd. Uncertain higher means certain lesser. Uncertain higher means risk is higher, RADR higher, CEC will be lower. Uncertain lower means it's a certain. Uncertain lower means it's a certain. Certain means risk is lower, the RADR lower, the CEC higher. Is that fine? Now let me read what the third part is asking. The third part. what he is asking here. It says which project should be selected. I think answer you would have given uh, whatever came. Why? And then he says if risk adjusted discount rate method is used, it is not calculation he is asking. He says if by chance the above you would have done by RADR. Sir, how would I apply RADR? You apply risky cash flows risky rate. If you would have given, then which project would be analyzed with a higher rate? Which project would be analyzed with a higher rate? Now higher rate means risk would be higher rate. You will apply in which project? Higher risk project you will apply. Now higher risk project would be one in which CEC is what? Lower. You see which project CEC is lower? X is lower, and it cannot happen that interchangeably used. CEC is lower here, that means the risk is more in this project, and if by chance any of the two projects would have been analyzed using a higher RADR, the RADR higher would have been for what? Project X. Is it fine? So that means basically how do we write the answer is, the way of writing the answer becomes as project X is more riskier. Project X is more riskier since it has what? Lower CEC. Hence if RADR method was to be used, then project X would be analyzed at what? Higher RADR. A small question more I can give if you want. The questions would be simpler. In RADR and CEC, question would be simpler. Sensitivity can create technical, decision tree or a probability tree, he can create scenario, he can create lengthy questions, it's okay. And some general questions in which we have the machinery replacement part, that would be there. That would be slightly odd or a difficult pattern can have. Means they can have something to think about it. In these two, is nothing thinking, only when he links thinking process comes. Let me give you a small question from my book, which is from the, I would have taken from the study material, I think. Which approach we are doing? Certainty equivalent, na? Yes. Let's look at this. You will not have, I'll just show you from here, and I expect you to calculate the answer for me. 26th. XYZ is considering the proposal of buying one of the two machines to manufacture a new product. Each of these machines require investment of 50,000 and is expected to benefit over a period of how many years? 4 years. After the expiry of the useful life of the machine, the seller of both the machine have guaranteed, the word highlight please, guaranteed buyback. When you have something called guaranteed buyback, the CEC factor is 1. Guarantee means confirmed. There is no if and but. The machine 5,000. Management of the company uses C approach to evaluate certainty equivalent approach to evaluate risky investments. Company's risk adjusted discount rate is 16. This is of no use. Risk free rate is, this will be used. The cash flows are these. So you have CFAT multiply by these, and please be careful. Last year when you have 5,000, it's as good as what? Certain cash flow. Calculate quickly A and B. Roughly you can calculate. It will help you in practice only. Calculate A and B. Then I'll show you. So proposal A, year, CFAT is uncertain cash flow, C factor, that will give you certain cash flow. And last year guaranteed, this is the 4th year, multiply by 4th year factor. Discount rate is 10%. Let me show you the answer. The first part I get 30,000 into 0.8, 0.7, 0.6, 0.51, 24, 21, 18, 15 and 5. This was also important, please. Guaranteed means it's confirmed here. Guaranteed means it's a confirmed here. So do not make a mistake. It was confirmed here. 1. And then you get certain cash flows using that factor, present value factor at the rate 10% PVCF. Done. Second part we have, I think second I would have given them as a homework. You can, once you've done the first part, second you can always try them. Sorry. 18,000 into 0.9, 36 into 0.8, 24 into 0.7, 32 into 0.4, and then accordingly 5,000, and discounting factors 0.9, same factors you have. Multiply and get the answer. Done. Now moving forward, on the next slide I've just taken the difference between RADR and certainty equivalent approach. The difference between RADR and certainty equivalent approach. RADR and certainty equivalent approach. Risk is adjusted at discount rate. Risk is adjusted at cash flow level. Risk adjustment at discount rate. Risk adjustment at cash flow level. Risky cash flows would be discounted by risky rate. Risk-free cash flows will be discounted by risk-free rate. Higher the risk, higher would be the RADR. Higher the risk, lower would be the CEC. Higher the risk, higher would be the RADR. Higher the risk, lower would be the CEC. Then the next part comes as decision tree, in which a concept of a joint probability comes in. Next comes a decision tree, in which a concept of joint probability would come in. Probability of a two or more events taking place together we call joint probability. This we would have covered in M&A also to some extent. If this happens 40, then can happen 60 or a 70. If this happens 60,000, next year could be a 90,000 or 95,000. This 70% depends on this 40. Joint probability is 28%. This 30% depends on this 40. So happening of this event is 12%. 40% depends on this 60. 24. 60% depends on this 60. 36. That could be a decision tree. I should be calling this as a probability tree because it's a probability. Decision tree, I'll show you how exactly decision tree comes in. So probability of two or more events taking place. Coming back to question number 32. So read question number 32 once quickly, please. In question number 32, a firm has an investment proposal requiring an outlay of rupees 80,000. The investment proposal is expected to have 2-year economic life with no salvage value. The firm has investment proposal and outlay of 80,000. The investment proposal is expected to have 2-year economic life with no salvage value. In year 1, 0.4 probability that cash inflow after tax will be 50,000. CFAT would be 50, 40% probability. 0.6 probability that cash inflow after tax will be 60,000. That means first year you learn how much? 40,000 or 50,000 or 60,000. 40 and 60 is the probability. If in first year you earn 50, then second year would be 24,000, 32,000 and 44. Probabilities are as follows. If in the first year you earn 60, then second year would be 60, 50 and 60. Probabilities are as follows. Use 10% discount rate for this type of investment. Construct a decision tree. If we say decision, it's okay, decision tree, and calculate the expected NPV. We'll calculate. Actually, this is called a path approach. We make different paths. Instead of making, I can do in a simpler way also, but generally we do it using a path approach. That means cumulate, we do all, there are 6 events which are taking place. So there are 6 paths which takes place. Look up please. So there are 6 paths which take place. I am on slide number 15. If you look at the decision tree, that how does it comes, this will come as in first year I'll earn what? 50, chances are 40, or I'll earn 60, chances are 60. Second year either 24, 32, 44, chances are 20, 30 and 50. The sum of the probability would always be 1. If I earn in the first year 60, then I would have what? 40, 50 and 60. Joint probability is what, sir? The probability of happening the events together. I am highlighting 50 and 20. That means this will happen. The probability of this event is what? 8%. 32 and 50,000. The probability of this path is what? There are 6 paths. If you look at, there are 6 routes basically. The probability of this is 12%. The probability of 44,000 and 50,000 would be 20. So 3 and 3 paths are 40, 60, 50,000, 60,000, 60,000, 60,000. Probabilities are 24%, 30% and 6%. These are the probabilities. So the probabilities of happening the event is the 8%, 12%, 20%. The probability is 24%, 30% and 6%. These are the chances. The sum is 1. Now, how do we calculate if this type of a question comes in? You can do it by simple probability graph or probability also, but it has to be path approach. Look up please. Expected NPV, how do we calculate? There are 6 cases, 1, 2, 3, 4, 5 and there is 6th case here. These cases are nothing but these roots. 24, 50, 32, 50, 44, 50, 40, 60, 50, 60, 60 and 60. So we call it as, if you look at year 1 cash flow, you will earn what? 50,000. The factor is what? First year factor I have taken to calculate the present value of cash flow. This second year would be 24 into 0.826. So the total PVCF would be first year plus second year 65,274. How much was your outflow? 80. We are not multiplying 80 with probability. We have not done probability also. It's complete 50 I have taken, complete 24 I have taken. Only multiply by first year factor and second year factor. I get negative NPV and 8%. Probable NPV is what? 1178. Now understand how do we read? We read I will have a negative NPV of 14,726 whose chances are 8%. Whose chances are 8%. In second route if I fall 50,000 first year, 32,000 second year. That means, sir, this is same. I have not redone the calculation. 32,000 into 0.826, and this minus 80,000 will give me what? Minus 8118, whose chances are what? 12%. That means I will have negative NPV of 8118. This, sir, what is last one? Last one is the after multiplying probability. We take a decision. If I say that I can have loss of 8,000, chances are 12. I can have a gain of 1794, chances are 20. I can have gain of 7580, chances are 24%. Gain of 15840, chances are 30. Gain of 2400, chances are 6%. That's how it comes. And then third part, I think he is asking the second part, worst outcome. Now worst outcome, do not look at expected NPV, please. Worst outcome is, what is your worst NPV amongst all? Is 14,726, and chance of happening it is what? 8. And please understand, if you give the answer, this is not the answer. Answer, how do we give it? He is asking very clearly. So he is asking very clearly, what will be the net present value will the project yield if the worst outcome is realized? Worst outcome is, out of 50 and 60, 50 is worst. Then out of 24, 32 and 44, 24 is worst. That means happening of lower in the first year, happening of lower in the second year. What NPV it will give me? Minus 14,726. And what is the probability of the occurrence of this event? The probability is how much? 8%. Then next is, what is the best outcome I can have? Best outcome would be earning of 60,000 and then again earning of 60,000. Chance of earning this is only what? 6%. He is not asking me to calculate expected. He is asking me NPV of the worst and its probability which comes out. Now if you want, you can quickly cross check the numbers, please. Quickly cross check all the numbers. I have given the answers on the one slide only. Worst outcome, best outcome, and since ENPV, we take decision on this expected NPV. Since expected NPV is positive, we will accept the project. Quickly check the answers, please. Examination says decision tree, you write decision tree, otherwise it's a probability tree. Quickly look at the numbers if you want. Done? Now look at the next question. Read the next question once. 34. Read out quickly, please. 34. A firm required to choose between constructing a large or a small factory to produce a new line of a product. So decision is between large and small. The large plant would be needed if the future brings high demand for new products. But the large plant would have new cash inflows below rupees 10 lakh outlay if the demand is medium or low. But the large plant would have new cash inflows below rupees 10 lakh outlay if the demand is medium or below. It means if you apply a new plant, outflow is 10 lakh, inflows would be lower if demand is medium or low. That means three type of demand could be there: high, medium or low. The present value of cash flows are 14 lakh with high demand, 9 lakh with medium and 6 lakh with low demand. Now simple words if I put, if I go for large plant, then my outflow would be how much? 10 lakh, and chances are if demand is high I learn how much? 14 lakh inflow. If demand is medium I learn 9 lakh inflow. If demand is low I learn what? 6 lakh inflow. After full stop. The smaller plants produces lower return if the demand is high. The smaller plant produces lower return if the demand is high, but have positive NPV at medium demand. Actually, in the case of a large plant, NPV was negative. If you look at, because the inflow is negative at medium. In the small, expense would be lesser, return would be lesser, but NPV would be positive at high and medium. So he says the costing will be 2 lakh with respect to what? Outflow, and would represent cash inflow of 3,20,000 high demand, 2,70,000 with what? Medium demand, and 1,80,000 for what? Low demand. So basically I can construct my tree easily, that with high demand, expense, and what are my inflows? With medium demand, inflows. Draw a decision tree. This is actually decision tree. The decision is mutually exclusive. What is net present value of each of the alternatives? If 40% chances of high demand, 40% chance of medium, and 20% chance of what? Low demand. Actually, correct decision tree is this. If I speak nicely or perfectly well, we say decision is not about large and small. If large and small both will give me the negative answer, then I will not even construct a factory. Decision should be, if decision is here, construct a factory, do not construct a factory. Decision between construct a factory, this is called node. We are standing at node. Decision we are taking, should I construct a factory or should I not construct a factory? If I do not construct factory, question cannot be done, 0. If I reach here, construct a factory, I reach at an event, then two events take place, either large plant or what? Small plant. If I go with the large plant, then three events are possible: high demand, medium demand, low demand. High demand will give me what? 14 lakh. Medium demand will give me 9. This will give me 6 lakh. If I go with the small, then I have three possibilities: high demand, medium demand, low demand. So these are the chances. So basically, decision is construct factory, do not construct factory. If you construct a factory, the large plant or a small plant. If you go with the large plant, then three possible scenario. If you go with the low demand, then three possible scenarios. And then we have NPV if large plant is constructed. PV of cash inflow 14 lakh into 0.4. I think factory did not give. These are PV only. These are present values only. 14 lakh into 0.4. 9 lakh into what? 0.4. 6 lakh into 0.2. PV of a cash inflow minus outflow gives me what? NPV. Gives me NPV. That means if I go for the large plant, my probable NPV or NPV would be, expected NPV would be what? 40,000. And if I go with the small plant, calculate on your own what comes out. Calculate quickly please, what comes out. $72. $72,000, yes. So which one is better off? Large is by chance written there, like on this slide. How can large come? Which is giving a better answer? Small plant, na? So small is giving. This was question number 34. So which one would be better? Which one is giving you higher NPV? Small plant, na? So by chance it is You can cut down this part here. Small plant is giving you NPV what? 72. Large is giving you what? 40. So decision would be construct which plant? Construct small plant. Construct small plant. Since it gives higher NPV. Construct small plant since it gives what? Higher NPV. So whichever gives me higher NPV, I'll go for it. If both were giving me negative, I'll go for what? Do not construct. It's not lower. Do not even construct. Both are negative. Nalike. Do not construct then. This was decision tree. Now coming to the sensitivity analysis. A very, very important approach for the exam. A very, very important approach for the exam. Sensitivity analysis is called what if analysis. What if is means it's basically under this approach we'll try to see with change in different factors, maybe the output, maybe the units, maybe the inflows, maybe the outflows, what is change in the NPV. So that's called sensitivity, and we are trying to check NPV is sensitive to different factors to what extent. The more sensitive NPV is, that means that factor is a very sensitive factor, or that factor has to be very important for the purpose of project to be viable. Sensitivity analysis is the responsiveness of a change in NPV due to change in any factor affecting the NPV. That means sensitivity, under sensitivity check that what are the factors which affect NPV, and if they change, then what is the change in the NPV coming as. For example, if inflow changes by 10%, that means there is change of 10% in inflow, then NPV changes by 50, whereas if outflow changes by 10%, NPV changes by 20. I have not taken upside downside, it's a change I am saying. That means I change my inflow, the net present value change came 50%. I change outflow by same percentage, but the NPV changed by 20. It means if I change this as a 10, NPV changes by 50. If I change this as a 10, NPV changes by 20. So the inflow is more sensitive towards the NPV, or NPV is more sensitive towards the inflow, because if that changes 10, there is a huge change in NPV comes. By chance inflow reduces by 10, NPV will fall by how much? 50%. It means NPV is more sensitive towards what? Inflow. That factor has to be given a very important due care while solving questions or doing the project. Different factors could be inflow, outflow, cost of capital, sale price, variable cost, etc. Now when we are doing this, we'll change one factor is changed at a time. That means we'll change one factor, we'll check the impact on NPV. We'll change one factor, we'll check the impact on NPV. So one factor is changed at time. The steps to be calculate NPV is calculate normal NPV. When we do one question, you'll understand, don't worry. Calculate normal NPV, assume adversity. Adversity is, generally we assume adversity, although question also gives the hint. That means we'll change each factor in such a way which will lead to decline in the NPV. So assuming adversity is changing each factor in such a way which will reduce what? NPV. Changing each factor in such a way reduces NPV. Recalculate NPV and then check what? Sensitivity. That means we'll recalculate NPV, first normal NPV, then adversity, then new NPV, and then we'll say what is the percentage change in NPV coming. Whichever factor is leading to more change, that factor would be more sensitive. One important part is, sir, can we assume favorable impact? It's up to you. Whatever amount you assume, there are two approaches, we'll do both of them. One is when we change factor and then calculate NPV. Second is a shock, we can say basically making NPV 0. That will come academic style later on. So practically I say I am changing some factor and there is a change in the NPV. When I am changing a factor and change in the NPV is coming, the factor which is changed least and NP changes by most, the factor is more sensitive. One due care has to be taken that each factor, whatever factor you change, that factor should be changed with the same percentage. For example, if inflow is changed 10, new NPV calculated. Outflow should also be changed by 10, new NPV calculate. The rest of the factor also changed by 10% and new NPV should calculate. Adverse impact, I have just given us some hint. How do you look at the adverse impact? Factor inflow decreases adverse, outflow increases adverse, KO increase adverse, sale price decrease adverse, variable cost increase adverse, and then we can calculate the NPV. KO I have taken it here. Sir, why you taken KO increase? Because when you increase the KO, your present value factor reduces. Let me look at the question once. We'll do a couple of questions on the practical side, then we'll come to the theoretical style of it, academic style of it. Question number 30. Question number 30. Read once quickly, please. It says, from the following details relating to a project, analyze the sensitivity of the project to changes in the initial project cost, annual cash inflow and cost of capital. That means we have to check the sensitivity, that is change in NPV, if the initial project cost changes, if the annual cash inflow changes and cost of capital changes. Initial project cost 1,20,000, annual cash inflow 45, life 4 years, cost of capital 10%. Which of the three factors project is most sensitive? Use annuity factor 10%, 11%. Now if you look at the data, he has not mentioned any approach. Prima facie I get a hint from here. The 10% rate, when it becomes 11, it's a 10% change. It is not 1%. Percentage change on percentage is 10. And when the rate of interest increases, it's a adverse impact. That is giving a hint. It is not necessity, but that is giving a hint that first you do is calculate normal NPV, then initial project cost increase by 10%, annual inflow decrease by 10%, and cost of capital instead of 10% take at what? 11%. So once again, this is giving a hint that if you are standing at 10 and it is becoming 11, that means it is giving a hint it's as good as a 10% change you have to assume, and that to be adverse. So why adverse? Because if the interest rate is changing from 10 to 11%, percentage impact on percentage is 10%. So steps would be, let's calculate the normal NPV. Verbally we can do 45,000 into annuity factor is given 3.169 minus 1,20,000 will get some number 22,605. That first part comes 22,605. Now we change annual project cost. Instead of 1,20,000, make it as plus 10% increase. How much? 1,32,000. So now we can do again 45,000, each factor one at a time, in 10% only. 45,000 into the annuity factor of 10% only, 3.169 minus 1,32,000. How much do we get? 10,000? 10,605. So how do we do it, sir, now? If I change my project cost increases by 10%, then my inflow, actually present cost, the cost was in 0 period, so automatically my inflow will decrease by 12,000 only. Cost is increasing by 12, so my inflow would have decreased by only 12,000. So we say 22,605 NPV becomes what? 10,605. What is the percentage change? 53.08. So if I look at my answer, How do I read this as? Look at this please. Then I can ask you entirely do on your own. Calculation of original NPV. Inflow minus outflow, I get original NPV of 22,605. Assuming adverse impact, although question gave me a hint, but still I write I'm assuming adverse impact. Increase initial outflow by what percentage? 10%. Your new outflow would be 1,32,000. New NPV will reduce from 22,605 to 10,605. Sensitivity would be equal to 53.08. It means, how do I read, sir? I read, this is my seva part, this is not the fare you have to write. If outflow increases by 10%, then NPV will decrease by what? 53.08%. Similarly, you can decrease the inflow and then calculate the impact, and then percentage, instead of 10, take discounting factor as 11. So if I decrease my inflow, my new inflow would be 40,500. 40,500, I can calculate my new NPV. I'll say if the inflow changes by 10, my NPV falls from 22,605 to 8,345. Quickly check once the entire answer, please. Quickly check once the entire answer. Quickly check the entire answer, please. This is practical style of doing it. We are changing each factors by same percentage. We change it by 10%, because if we change by different percentages, then we cannot check the impact. We can only calculate the movement. But if you have to select best one out, then each factor we are changing by 10%. So increase cost of capital by 10. Instead of 10, it will become 11. New NP would be 19,905, and sensitivity 11.94 means if the cost of capital increases by 10%, then NPV will decrease by what? 11.94%. So decision inflow is what? Most sensitive out of them. Fine. Let's try 31 now. Let's try 31. Red Limited is considering project with the following cash flows: year, cost of plant, recurring cost, saving. The cost of capital is 9%. Measure the sensitivity of the project to changes in the level of plant value, running cost, and saving. That means you have to change the cost of the plant, recurring cost, and the saving. Considering each factor at a time, we can consider one factor, because if we consider all factors, we cannot imagine the or understand the movement, such that NPV becomes 0. As of now, I am ignoring this line. The question what I am doing is by practical. When we say NPV becoming 0, that is academic style. Actually, this question should be done by this approach only. But for the purpose, since we are doing, let us learn the first approach clearly well. But that do not apply if this word comes. If this word comes, what has to be done? I'll tell you. What does it mean NPV becomes 0? So we'll redo this question once we have done as per previous question. Previous question is only for practice the previous way. This has to be done in a different way. Year given, factors given, more sensitive. So what I'll do is I'll change my all factors by 10 percentage, same way, assuming this line was not given, so I'll mark it this as B. So A part I'm doing by different method. The reasoning will come same, answer will come same in the sense that which is most sensitive. NPV becoming 0 is basically, this factor means is we change each factor. For example, if I push slightly something and it falls, and one I'm trying very hard but it does not fall. Sensitive is when I say small thing to you and you get hurt, and there are people you keep saying anything and you know who, and they keep saying anything, nothing will happen to them. That is basically non-sensitive. Sensitive is the lesser you touch and NPV becomes 0. The lesser you change, NPV becomes 0. Whichever factor makes NPV 0 is more sensitive. So we'll come back to it, don't worry. Let me do first my normal way. Normal way means using this only. Although this should not be done this way, but I have done for the purpose of practice. 13 and 31, 31 and 13. Mark it as important, please. Mark it as important. 13, 31, 31, 13. Let's suppose the wordings were not given, NPV becomes 0. Let's suppose that was not given. That's academic style. And we try our normal way. Original NPV. Can we calculate? Look up, please. I'll just quickly do with you, then I'll give you time to do. You keep checking the data first. Original NPV. Inflow, you have been given what? Saving minus recurring cost and factors are given. And outflow was given 10,000. We get NPV as what? 4914. No? Adverse impact means the outflow should increase by what? 10 percentage. Instead of 10,000 it will become what? 11,000. Very good, sir. NPV will become what? 3914. Change in NPV 20.35. Let's suppose if I had to read this line, how would read? If my cost of the plant increases by 10 percentage, my NPV would fall by what? 20.35. Yes. Second, recurring cost. Let's increase the recurring cost. What was the recurring cost earlier? 4,000 and 5,000. Will increase by what percentage? 10 percentage. So increase by, it becomes 4,400 and 5,500. So the new inflows would be 7,600 and 8,500. Can we calculate the new NPV? Yes. My change in NPV comes 16.04. It means if my recurring cost increases by 10, my NPV would fall by 16.4 percentage. Third is saving. Saving is a income number or expense number? Income. Income should be what? Reduced. So we reduce saving by what? 10 percentage. Saving was income, we reduce. That's an adverse impact. Actually, I have taken the adverse. Cost increasing, recurring cost increasing, saving decreasing, and my change come 46.38. We say if the saving decreases by 10, NPV would change by 46 percentage. This was assuming he did not mention that line. Now cross check quickly once, please. So which is most sensitive? Savings is the most sensitive factor. Quickly check, then I will do the both the questions by earlier method. Check the numbers, please. I hope they are coming right. Now it says if it question comes Even if question is silent, it's up to you what approach you want to use. I feel comfortable with this because it's easier to assume. Let's suppose he says NPV becomes 0. It means you have to check how much should I change these factors and NPV becomes 0. That means the more sensitive would be that factor which will make NPV 0 faster. Which will make NPV 0 faster. Understand why? Because if you apply very hard force and things change, that is not sensitive. You say something and things change, that's called sensitive. You would have heard in movies, someone touches, there was a movie Avatar, English Avatar, Hindi Avatar. You seen that movie? He'll touch some flower close. Even I was watching Bahubali some time back. In that also he jumps top floor, he touches something and that scene is there in that. I don't know which movie I was watching. But sensitive is Bahubali. Bahubali 2 versions, 1 and 2. Now like Avatar you've seen? Avatar? Huh? No Avatar? And in English, Hindi, Telugu, Tamil, every language it is there. Now like such a beautiful movie. But sensitive is they touch, closes. You've seen? That is called sensitive. And when you keep touching, nothing will happen. So that is called insensitive. So whichever factor makes my NPV 0 is sensitive. Basically purpose is whichever factor. Now without moving there, I have to make NPV what? 0. Remain on this slide only. Remain on this slide only. How much is your NPV? 4914. You tell me cost, and this NPV is in what term? Present value term. That means standing 0 period. You tell me cost should be increased by how much so that NPV becomes 0. No, I'm just asking by amount. If I have to make 4914, cost should be increased by how much amount so that my NPV becomes 0? 4914. 4914 na? So if I increase my cost 4914, my NPV will become 0. My original cost was what? 10,000. If I change my cost, that is basically increasing. If I change my cost or increase my cost by 4914, my NPV would become 0. That means basically I am saying if my cost becomes instead of 10,000, 14,914. Now how much is 4914 out of 10,000? 49.14. How do we read, sir? It means if I change my cost for 49.14, my NPV will become 0. That's why. Now saving. One thing is for sure, saving in the present value term. Saving in the present value term should change by how much? 4914. 4914 is not, it's actually some change will come in this first year, some change will come in the second year. But in present value term, the change should come what? 4914. Saving should be increased or decreased? Decreased. How much amount? 4914. If it's 4914 and my present value of saving is what? Anyone calculated present value of saving? Only present value of saving. Sir, how do we calculate? Let's calculate present value of saving. 12,000 into 0.917 plus 14,000 into 0.842. 22,792. If my present value of saving is 22,792, in that I have to change how much amount? 4914. How much percentage change? How much percentage change? 21.56. Understand what I am saying? Now look at this answer please. This is not 36, this is same as 31. It's A and B part basically. Look up please. Look up. We say our original NPV is 4914. If I reduce my NPV by 4914, my NPV will become 0. So cost increase by what? 4914. That means if you increase your cost by 49.14 percentage, it will make NPV as what? 0. Second case, decrease in present value of saving what? 4914. Out of total 22,792, I have to do what? I have to decrease this much amount. That means if I change my present value of a saving by 21.56, my NPV will become what? 0. Third is what? Recurring cost. Recurring cost I have what? 4,000, 5,000 in present value terms comes 7878. That means I change 4914 in 7878, that is 62.38. Then my NPV becomes 0. So you can think that which is making NPV 0 faster? Which is making NPV 0 faster? This needs 62 change. This needs 49 change. And this has to change only by what? 21. That means you touch something and it quickly changes. That's called most sensitive. Whichever factor makes NPV faster, 0 is what? More sensitive. Is that fine? Now let's redo question number 30 also. Let's redo as a practice 30th question also. What were the three factors? I have given on slide number 2. On slide number 2 you might have solution 35. It is as good as 30. This is as good as 30 B part. Which approach are we using? NPV becoming 0. You help me out. What was your original NPV? What was your 22,605? Cost you have no challenge, no problem. Cost should increase by how much? 22,605. Cost should increase by 22,605 to make NPV what? 0. What was your original cost? 1,20,000. In 1,20,000 change by 22,605, 80.84. Now I have written in the Seva part also, if outflow increases by 18.84, NPV would become what? 0. Then sir, let's talk about the inflows. Inflow, since every year are 45, it has to be changed in the present value terms. Decrease in present value of cash inflow by what? 22. And you have calculated present value of cash inflow in the first part, 1,42,605. So 22,605 change in 142,605. How much do we get? 15.85. 15.85. How do I read this sentence? If inflow decreases by what? 15.85, NPV will become what? 0. NPV will become 0. And third is change in what? Cost of capital. NPV will become 0 at IRR. That means indirectly he is asking us to calculate what? IRR. So if I calculate my IRR, I have tried here. At IRR, my inflow would be equal to outflow. Then apply that same concept, and this is what I was talking to you in the initial period, how the IRR can be touched in the exam. Look in annuity table under, sir, how many years? 4 years. If I try to look, when you go back and if you, since you have the notes in hand, if you look in annuity table 2.667, two rates you will get is 18% and 19%. When you solve them and apply, you will get the change. Rate would come 18.45. 18.45 means increase in KO should be 8.45. 8.45 change in 10%. Please understand. 8.45 change in how much percentage? 10% is 84.5. That means rate has to increase drastically to make NPV 0. Rate has to increase drastically to make NPV 0. It means now I read, how do I read academic style? I read as, if I change my cost by 18.84, NPV becomes 0. If I change my cost of capital by 84.5, 84.5 is a very, very heavy change, please. Then NPV becomes 0. That means someone you touch, he becomes, there would be some friends now. Someone you look by different eyes, he becomes angry. Someone you keep beating also, the friend will not become. Friendship happens, no? This happens. There could be some friends, and some you do not say anything, still they are angry. That is more sensitive. You always be careful. Yaar, he'll get Hindi, English I don't know, or Telugu what you say I don't know. He'll say, "Yaar, wo naraz ho jayega yaar. Chhod na usko. It's okay." Someone, and some friends are there. You keep teasing them till any extent. They do not even realize that something they are doing to us. They are so good. That means cost of capital is very good. The cost is good. NPV is very sensitive. He says, you do not touch me. I'll stop talking. Now, it's as good as this only. Do not touch me. This is exactly same thing. This is sensitive. So if you try to analyze both ways, if you look at the first part also, if you compare both of them, in that we were changing by 10 and NPV was changing smaller. In this, NPV is becoming earlier by small change in the inflow. The answer would remain same. In exams, sir, what to do? Sometime depending on data also you will have to take the call. For example, next question what I am doing with you, even if you try with the practical style, you cannot do. It has to be done with the academic style only. In case question specifies, then there is no choice. Whatever he specifies, do it. In case question is silent, then whatever method you're comfortable, actually more comfort comes by change in the percentages. But if by chance data is structured in such a way that data is not giving comfort, then you do the academic style. For example, 31 should have been done by academic style only, but since I wanted to practice, I have done both ways. So whichever factor changes least, NP becomes 0 is more sensitive. Is that fine? So we have decrease here, and answer I think comes the same. Same here, it comes out to this. Previous one also inflow was more sensitive, na? Yes, this also inflow is more sensitive. Now let's come back what? One question which I want you to try, which will be based on the sensitivity only and NPV 0. Question number 71. This is exactly how he'll give the table IRR. In the previous question I have not shown you, don't worry. This is exactly how he'll give the table. Read this question once quickly from your side, please. Read this quickly once. Read this question once quickly. Done? Should I read out? This is which question number? 71. I think I might have given you answer, but it's okay. I'll see from my side. Look up please. 71 question. I think you might have the answer with you also. I have given that printed answer also, but let's try to read from here. The easygoing company limited is considering a new project survival. It is estimated IRR 16 having life of 5 years. Financial manager has studied that project with sensitivity analysis and informed that annual fixed cost sensitivity is 7.8416, and whereas cost of capital sensitivity is 60%. So indirectly they are giving a hint that cost of capital increases by 60% or annual fixed cost increases by 7.8416, your NP will become what? 0. Otherwise they will not give you this kind of a language. They would have given change this change comes, change this change comes. This is NPV becoming 0. Other information available are PV ratio, profit volume 70, variable cost 60, annual cash flow 57,500, ignore depreciation on initial investment and impact of taxation, calculate the initial investment of the project. Now we know one thing, at IRR NPV is what? 0. Assume this is a cash inflow only, and do we have 16% factor given? 3.274. So if I multiply at IRR, what happens? At IRR, PV of a cash inflow is equal to outflow. So I have Inflow 57,500 multiply by what? 3.274. Can I get the outflow? How much outflow do we get? 188,255. First part is done. Na? It's straightforward because we know at IRR inflow is equal to outflow. This is not a discount rate KO. This discount rate is cost of IRR. IRR he has given it to you. So it becomes 16%. Now how much is my cost of capital sensitivity? 60. It means if my cost of capital is X plus 60% will make my NPV 0, and we know NPV becomes 0 at what? IRR. NPV becomes 0 at IRR. That means X plus 60% should be equal to 16%. Understand what I am saying? X plus 60% should be equal to 16%. So second part if I try, first was at IRR I know inflow is equal to outflow, I get my outflow, cost of project, initial investment, whatever you want to call it as. Second I say NPV, let the cost of capital be equal to X. If KO increases by 60, then NPV becomes what? 0. At IRR also we know NPV is what? 0. It means X plus 60X should be equal to what? 16. So your X would be equal to what? 10%. And he is asking NPV or X only? What is he asking? NPV. So NPV would be nothing but 57,500, and please make sure when you multiply this 3.791 is the annuity factor at what rate? Annuity factor at 10% for 5 years. This comes this part here. This becomes this part. Third part, apply the brain please on your own. First two parts. First two parts were IRR, use of IRR. First part was IRR concept, inflow equal to outflow. We calculated this value. So screen yours is freezed now, right? So at IRR inflow is equal to outflow. That means at IRR PV of inflow is equal to outflow. You'll get 188 to, this is exactly what you're getting. How much you're getting? Answer is given in the book, na? 188 255. Second part we said let the cost of capital be equal to what? X. KO increases by what? 60%. NPV will become what? 0. At IRR also we know NPV is what? 0. That means at 16% NPV would be what? 0. So when we solve X plus 60X 16 we get 10%. If cost of capital is 10, if I have to calculate NPV, it will be annual CFAT into annuity factor at the rate of KO minus outflow should be equal to this, and I get NPV as this. If you want to copy, you can copy these two parts please. If you have the answer, it's okay. I don't know. This answer is in the with the question only, with the question material only. If it is there, if you are comfortable with that, it's okay. Otherwise, you can look at these two parts which comes out. So at IRR we have inflow is equal to, let me see how has been given there. If it is given okay, that's perfectly fine. This given NPV should be 0, 188 255. Net present value, basically he is applying some etc blah 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 something. I have done in the simple language. What I have done in the simple language is, basically we know at IRR also NPV is 0, and I know at IRR also NPV is 0, and KO increases by 60 means NPV will become 0, and we have solved this equation. So when we solve this equation, I get my NPV solution. So how did you get 3.791? 3.791 was annuity of 10%. This is how I got 3.791. So you can check once. Third part, if anyone has got the hint, try on your own please. Annual fixed cost. Third part, if anyone has got the hint. It says you have to find what? Annual fixed cost. Annual fixed cost, no, third part. Now when you have to find annual fixed cost, sensitivity of annual fixed cost means what? If annual fixed cost changes by 7.8416, NPV would become what? 0, no doubt. And you know how much is your NPV? 29,728. 29,728. Now I given the hint. It is not it's annual. Annual means 1 year, 2 year, 3 year, 4 year. In that, in present value term, change should come. Again I am giving you a hint. In present value term, change should come what? 7.8416%, and that amount should be equal to, if fixed cost is X into 7.8416 into 8 point, look up please. If fixed cost is X, X into 7.8416X is a change. This change will come what? If I draw diagrammatically, how many is the life? 1 year, 2 year, 3 year, 4 year and 5 year. So 1, 2, 3, 4, 5. This change should come in 1, 2, 3, 4, 5. And if you bring back to 0 period, in present value term, this should be equal to what? 29,728. We say X into this into annuity factor of cost of capital should give me a value equal to what? 29, because your amount has to get what? You have to increase your fixed cost in such a way so that when I increase my fixed cost and when I bring back it to 0 period, my NPV becomes what? 0. So I say X is the cost. Based on X cost, we are already getting NPV of 29,728. In that I am making a change of 7.8416. If I am making a change of 7.8416, then into annuity factor at this rate should give me X equal to what amounts? Try the fourth and fifth part if you got the hint. Try fourth and fifth part please. Fourth is asking what? Units. Fourth is asking is units. Estimated annual unit of sales. Anyone who can give me the hint? My variable cost is how much? 60. PV of a ratio is 70. Contribution by sales is PV ratio. Contribution would be 70% of sales. Variable cost is 30 of a sale. Can I reverse calculate the selling price? 200. Fine. Selling price minus variable cost into quantity gives me what? Selling price minus variable cost into quantity contribution minus fixed cost will give me cash flow. Since there is no tax, will give me cash flow. So it will give me a cash flow, and I come to know this part here, and when I solve I get 1125 units. So once again, using my PV ratio contribution, I get my selling price. Using this selling price and this ratio, I get what? This part here, and using this part I can reverse calculate what my number of units. Is fine. And the next last part, you are expert at break-even units, I think. Costing. You are expert at last part. Costing. Hmm? 7-1. How do you get? Formula is what? Fixed cost by? This question did not mention any method, but you should know that it was based on the NPV becoming 0, because the question was framed in such a way the answer would come accordingly. And I think the answer which I have given more or less would be same, only few things I extra do it step by step, and that comes in. Otherwise, if you do try a shortcut, answer would come same. Is fine. This was sensitivity analysis. Very, very important from the examination point of view. Very, very important from the exam perspective point of view. So let's wind up here. We'll continue in the next session. This part. Take care. Bye bye. Wind up here. Next session will continue this part.